All right, next thing we want to do is talk about how these intra-entity transactions work in the presence of a non-controlling interest. And so, first thing we want to do is look at some wording here from FASB in paragraph 810-10-45-6, which gives some guidance on how you treat intra-entity transactions where you have unrealized profit at the end of a period. And so essentially it says that the amount of intra-entity profit or loss to be eliminated is not affected by the existence of a non-controlling interest, and that this elimination is consistent with the underlying assumption that the statements represent the financial position of the company as a whole, being a single economic entity. The interesting part is the next sentence. It says that the elimination of the intra-entity profit or loss may be allocated proportionally between parent and non-controlling interest. And so notice it says may be allocated proportionally. It doesn't say must be. So what that's interpreted to mean is there's some flexibility there. Depending on the type of transaction you've got, you may or may not allocate proportionally between the parent and non-controlling interest. In the book, they indicate that it doesn't make any sense to allocate proportionally between parent and non-controlling parent this intra-entity profit when you've got a downstream type sale going on, going from parent to sub, because the profit is totally with the parent, not the sub, and therefore the non-controlling interest has no interest in that intra-entity profit. And so bottom line is the book says, hey, it's logical to say or to not have this allocation in the face of an intra-entity profit due to a downstream type transaction. It's totally allocated to the parent. And so that's basically they say, using that logic, that's what we're going to do in this book. Doesn't mean you have to do it that way, but it kind of makes sense to do it that way. So only in the face of an upstream transaction would you have this intra-entity profit existing in the non-controlling interest. So we'll look at both types of transactions, and really it's a matter of, it's still the star G entry, it's still the TI entry, it's still the G entry. It's just a matter of, as well as all the other entries that you've learned from past chapters, but we'll not rehash on those. But it's just a matter of the accounts that you have to deal with, downstream versus upstream. So anyway, so they use this example. We're going to use The one in the book here, hopefully it matches up. Sometimes they don't. But here we have top company acquiring 80% of bottom company for $400,000 on January 1, 2012. Make that 2014, but anyway, I guess it really doesn't matter when it is. Hopefully the numbers match up here. It says 2014 in the book, 2012 here, really doesn't matter because they're going to go with consecutive years after this. So the same numbers apparently. Top pays $400,000. Acquisition date fair value of the non-controlling interest is $5,000 or $100,000, so $500,000 total of both the controlling interest and the non-controlling interest. Top allocates the entire $50,000 excess value, fair value of book value to adjust a database owned by bottom to fair value. Okay, so that we're going to have to amortize that. And they say the database has an estimated remaining life of 20 years. So we're going to have, on that database, we're going to have to amortize a total of $2,500 a year, and then allocate that out to the controlling interest and the non-controlling interest. And so, oh, they do, they do jump. That must be a typo then. They acquired them January 1, 2014, not 2012. All right, so the sub reports net income of $30,000 in 2014 and $70,000 in 2015. Dividends declared in 2014 are $20,000, and in 2015, $50,000. And so there's this $10,000 intra-entity receivable that exists as of December 31, 2015. And so they give you the intra-entity inventory transfers for the 2 years between the two companies. For 2014, there's gross profit of, well, transfer prices are $80,000, historical cost $60,000, so there's gross profit of $20,000. In the ending inventory balance for 2014, you've got $16,000 still left, and so you've got a gross profit percentage of 25%. So you multiply the 16 ending inventory times the 25%, and you come up with a gross profit remaining in year-end inventory for 2014 of $4,000. For 2015, you've got gross profit remaining of $60,000 using that same formula, but this time you have a gross profit percentage of 30,000. So bottom line is your and assuming that you're going to recognize these in the next period, you're going to defer that 4,000 income to 2015, and the 6,000 you're going to defer to 2016. So you got to take care of those. So just like we've seen in the past, in this earlier chapter, we've got to deal with this. Well, how do we deal with this? Well, this is a downstream sale, and so the controlling interest is not affected. Bottom is not affected. The only thing that it's affected is Topps Records. And again, they're using the equity method here. And so here's the three entries that we have to make. We have to make an adjustment on December 15, this star G, to Topps Records. We increase our investment in Bottom to recognize the income for 2015 of $4,000 due to the intra-entity transfer that was made in 2014, but a profit not recognized because it wasn't transferred to a third party till 2015, right? And then we're increasing our profit by $4,000 by reducing cost of goods sold. And then we do our normal TI transfer to eliminate sales and cost of goods sold. And then consolidation entry G is where we're taking this out of ending inventory, or taking the profit out of ending inventory, and we're increasing cost of goods sold, because that gross profit is still sitting in ending inventory, and the cost of goods sold. Our revenue is, or excuse me, our income is still overstated by the 6,000 gross profit in 2015. We're not going to recognize that till 2016, so we've got to increase our cost of goods sold to reduce income in 2015. Then we'll turn right around and do a star G for 6,000, just like we saw earlier at the beginning of 2016, right? All right, so what if you're doing an upstream inventory transfer? Well, in this case, this affects the subsidiary Bottom because the gross profits are attributed to them, not Top. And so you've got the same entries, you just are going to make them to different accounts. And so star G is going to reduce Bottom's beginning 2015 retained earnings balance. Remember, when this was a downstream, the debit was to investment in Bottom. Well, here the debit is to 2015 retained earnings of Bottom, and you're going to decrease cost of goods sold by crediting it for $4,000. Note here that when you're doing your other consolidating entries, because you've made this star G adjustment to bottoms retained earnings, basically it's reduced bottoms retained earnings from 310,000 down to 306,000. So it affects your consolidation entry S, and thus reflects the correct amount of investment by the top company, the controlling interest, as well as the proper number for the non-controlling interest. So, simple difference in the downstream versus upstream, just different accounts affected. But notice in both instances, cost of goods sold is your credit. But when it's downstream, investment in whatever the sub is, bottom in this case, and when it's an upstream sale, you've got to adjust the sub's beginning retained earnings for that next year by reducing it. So, not too difficult. But it does change the numbers. So note how the investment numbers in entry S change with the upstream sale, because you've reduced retained earnings of the sub. In the downstream sale, you didn't have to adjust the retained earnings of the sub. So, essentially what happened here? Well, 80% of the reduction went to Top's controlling interest, and then 20% of the reduction went to the non-controlling interest. So, not too hard. Should be pretty easy. All right, so that's all we're going to handle in this chapter. I just wanted to hit the sale of inventory, and because by far that's the most prevalent type of transaction you're going to have in a parent-sub sort of relationship. You can have other types of transactions. You can have sale of equipment, you can have sale of land, but the main thing is that you need to know is how do you handle inventory, because if you can handle inventory, you can handle land sales, you can handle equipment sales. So, anyway, that's it for Chapter 5.